All right, let's talk about a financial tool that could totally be your ticket to building wealth, the mutual fund. We're going to cut through all the jargon and show you exactly what they are, how they work, and most importantly, how you can get in on the action.
So let's start with a big idea. Imagine you want to invest in the stock market, but you're just not sure which stocks to pick. I mean, who is? Or maybe you don't have a ton of cash to buy into all the companies you're excited about. Well, what if you could do both? Easily, without breaking the bank. That's the exact problem mutual funds were invented to solve.
Okay, so let's dive right into this. To really get how they solve that problem, we need to be super clear on what a mutual fund actually is. At its heart, a mutual fund is basically a collective investment. Think about it. A company pools money from a whole bunch of investors, people just like you and me, and then uses that giant pool of money to build a diverse portfolio of stocks, bonds, or other stuff. It's really all about harnessing the power of group investing.
This slide right here breaks it down beautifully. You and a bunch of other investors all chip in your money. A professional fund manager takes that big pot of money and makes all the tough investment decisions. And the goal? Well, it's to generate returns that then get shared with everyone who invested. It's kind of like a potluck dinner. Everyone brings a dish, and a professional chef, that's your fund manager, creates a meal that's way better than anything you could have made on your own.
So that's the big idea. But how does this whole machine actually work behind the scenes? Who are the key players making sure everything runs like it's supposed to and that your money is safe? Okay, I know this chart might look a little intense at first, but don't worry about it. It just shows all the different people and companies involved in making a mutual fund run. We're going to break down the most important roles for you right now, starting with, the brains of the whole operation.
So the heart of the whole thing is the asset management company, or AMC. This is the company that actually hires the fund managers who make all the calls on what to buy and sell. They handle everything day to day. And to make sure they're legit, regulators like SEBI require them to have a pretty hefty net worth, at least 500 million rupees. So they've got skin in the game.
But the AMC isn't acting alone here. First, you've got sponsors who get the whole fund started. More importantly for you, though, you have trustees. Their entire job is to be a watchdog, to make sure the AMC is always acting in your best interest. And then there's the custodian. That's usually a bank that physically holds on to all the stocks and bonds the fund owns. This whole setup is designed to create a system of checks and balances to protect your money.
Okay, now that you get the mechanics, let's talk about the fun part, choice. See, not all mutual funds are the same. They come in a bunch of different flavors, all designed to meet different financial goals.
So the first big question you got to ask yourself is this. Are you looking for a steady, regular income, or are you trying to get long-term growth? If you want income and you're not a huge fan of risk, debt funds could be right up your alley. They invest in things like bonds. But if you're willing to take on a bit more risk for the chance of bigger returns down the road, equity funds, which invest in stocks, are built for that kind of growth.
And the next choice is all about your style. Do you want a fund manager who's actively trying to pick winners and beat the market? That's an active fund, and it usually costs a little more in fees. Or would you rather take a more hands-off approach that just tracks a market index, like the Nifty 50? That's a passive fund, and it typically has much lower expenses.
All right, so you get the what, the how, and the why. Let's get practical. How do you actually go out and make your very first investment?
The great news is, getting started has never been easier. Seriously, you can go old school with a paper form if you want, or you can do everything online through the fund's website or even its app on your phone. You can also work with a registered distributor who can walk you through the whole thing.
Now, before you can invest, there's a quick one-time process. The most important first step is getting your KYC, or Know Your Customer registration done. It's a mandatory verification thing. Once you've got that sorted, you just give them your personal and bank details, and as soon as the mutual fund company gives you the thumbs up on your documents, you are officially ready to go. So, finally, how do you actually want to put your money in? Are you going to go all in with a one-time lump sum investment? Or would you rather take a more disciplined route with a systematic investment plan, or SIP? That's where you invest a smaller, fixed amount every single month. A SIP is an awesome way to build the habit of investing and just stay consistent over the long run.
So, here's the bottom line. Mutual funds are a seriously powerful tool. They give you access to professional managers and instant diversification no matter what your financial goals are. Now that you have these building blocks, you can actually make smart, informed decisions. So the real question isn't just about investing, it's about the financial future you want to build for yourself. What's that going to look like?